Welcome to FXTech's comprehensive USD JPY analysis for November 10th through 15th, 2025. This week marked a critical turning point for the dollar-yen pair, with powerful fundamental shifts driving significant price action. We'll examine the dramatic Fed hawkish pivot, analyze the technical breakout above key resistance, and provide you with actionable trading strategies for both short-term and medium-term timeframes. Our analysis synthesizes insights from 5 major Forex sources to give you the complete picture. Let's dive into what could be the most important week for USD JPY in months. USD JPY delivered impressive gains during November 10th to 15th, surging 0.8% or 122 pips to reach 9-month highs. The pair decisively broke above the critical 154.47 resistance level on November 12th. Then tested 155.03 on November 13th, the highest level since February 2025. This represents a significant technical achievement. The weekly trading range spanned 349 pips from 151.54 to 155.03, with the pair currently consolidating at 154.004, just below the 155 psychological level. All 5 major Forex sources we track, TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex, confirm strong bullish momentum throughout this period, with steady buying pressure supporting the rally. The game changer this week was the dramatic shift in Federal Reserve rate expectations. CME Group data reveals that the probability of the Fed holding rates at 4% in December surged to 54.25%, up from just 5.49% 1 month ago. That's a nearly 10-fold increase in just 4 weeks, one of the most significant shifts in market expectations we've seen in recent months. This means the market has gone from almost certainty of a December rate cut to a coin flip, with slightly better odds favoring no cut at all. Fed policymakers' recent communications suggest that a December rate cut is no longer certain. This hawkish pivot provided powerful fundamental support for USD strength, particularly against the yen, given the already wide interest rate differential between the two economies. The structural foundation supporting USD JPY is the massive 350 basis point interest rate differential between the US and Japan. The Federal Reserve maintains its policy rate at 4.00%, while the Bank of Japan holds at just 0.50%. This creates one of the widest differentials among major global economies. For traders, this means earning approximately 3.5% annually just for holding long USD JPY positions, what we call positive carry. As Daily Forex aptly put it, you get paid at the end of every day to be on the long side. This makes U.S. fixed income assets significantly more attractive than Japanese bonds, driving persistent capital flows toward the dollar. The carry trade dynamic creates a structural bid under USD JPY that makes dips attractive buying opportunities. November 12th marked a crucial technical milestone when USD JPY decisively broke above 154.47 resistance. This level had capped gains for approximately 2 weeks, making the breakout particularly significant. What confirms the strength of this move is that former resistance has successfully converted to support. We've seen 2 subsequent pullbacks find solid support right at 154.47, with buyers defending the level aggressively. This indicates strong commitment from market participants. The breakout triggered additional buying momentum and confirmed the continuation of the uptrend from the 139.87 low. Volume increased significantly during the breakout, confirming genuine buying interest rather than a false move. This technical development has opened the path toward our next targets at 156.05 and the key structural resistance at 158.85. Let's map out the critical technical levels that will guide our trading decisions. On the resistance side, we're looking at 159.00 as the long-term target from Daily Forex, 158.85 as major structural resistance from the 2024 high area, 156.05 as the 100% projection level, and 155.03 as our recent 9-month high. For support, the most critical level is 154.47, our former resistance that's now turned support. Below that, the 153.00 to 153.50 zone represents strong buyer interest and critical short-term support. A break below 152.81 would signal potential short-term topping. The 55-day exponential moving average at 151.05 provides additional support, with the psychological 150.00 level as major support below. The trading implication is clear. As long as USD JPY holds above 152.81 to 153.00, the path of least resistance remains firmly to the upside. For the next 1 to 2 weeks, we assign a 65% probability to the bullish scenario. We expect a break above 155.03 to target 156.05 within this time frame, supported by the Fed's hawkish shift and the 350 basis point rate differential. The positive carry encourages holding through volatility, while strong buyer support at 153.00 to 154.00 provides a safety net. Our trading strategy: buy dips to 153.50 to 154.00 with stops below 152.00, targeting 155.50 to 156.50 for a risk-reward ratio of 1 to 2 to 1 to 3. There's a 25% probability of a neutral scenario, with consolidation in the 153.00 to 155 range, as bearish divergence on the 4-hour MACD suggests momentum may be waning. The bearish scenario carries just 10% probability, requiring unexpected dovish Fed signals or Japanese intervention. Looking at the 1 to 3 month horizon, we assign a 75% probability to the bullish scenario. We expect USD JPY to grind higher toward the 156 to 159 range, supported by the Fed maintaining 4% through Q1 2026, and the Bank of Japan maintaining 0.5% with no change expected at their December 18-19 meeting. The 350 basis point differential will persist, supporting carry trades, while the technical structure remains intact with the larger uptrend from the 2021 low of 102.58 resuming. Our timeline. Weeks 1 through 4 see consolidation and breakout above 155, targeting 156 to 156.50. Weeks 5 through 8 grind toward 157 to 158. Weeks 9 through 12 test the 158.85 key structural resistance. We assign 80% probability to reaching 156.05, 60% to 158, and 50% to 158.85 within 3 months. Every trade has risks, and it's crucial to understand them. On the upside, supporting further gains, we see a 30% probability of a Fed super hawkish surprise, with no cuts through mid-2026, potentially spiking USD JPY to 160 plus. There's a 25% chance of a BOJ dovish surprise, delaying rate hikes indefinitely. A 40% probability that U.S. economic resilience supports Fed higher for longer, and a 35% chance that a risk-on environment diminishes safe haven yen demand. On the downside, threatening the rally, the primary risk is Japanese intervention, with a 40% probability above 155 plus that could trigger a 200 to 300 pip correction. A Fed dovish pivot carries 20% probability, a BOJ hawkish surprise 15%, global risk-off events 25%, and technical breakdown just 10%. Risk management is essential. Monitor Japanese officials closely above 155 plus. Use appropriate stop losses, and scale positions. Here's our recommended trading approach. For short-term traders with a 1 to 2 week horizon, enter on dips to 153.50 to 154.00, with stops below 152.00. Target 155.50 to 156.50 for a risk-reward ratio of 1 to 2 to 1 to 3. Use moderate position sizing with a 65% success probability. For medium-term traders with a 1 to 3 month horizon, scale into positions on dips to 153.00 to 154.00, with wider stops below 149.00. Scale out at multiple targets, 156.00, 157.50, 158.50, and let 25% run toward 159 plus. This offers 1 to 3 to 1 to 5 risk reward with larger core positions and a 75% success probability. Plus, you'll earn approximately 3.5% annual carry while holding. Key events to monitor: December 10th FOMC meeting, December 18th 19th BOJ meeting, January 2026 U.S. employment and inflation data, and the January 28 through 29 FOMC meeting. Let's summarize the 7 critical insights from this analysis. First, the Fed hawkish shift is a game changer. The tenfold increase in no-cut probability fundamentally supports the dollar. Second, the 350 basis point differential provides structural support, making carry trades highly attractive and creating persistent buying pressure. Third, the technical breakout is confirmed. The break above 154.47 and test of $155 confirms uptrend continuation from 139.87. Fourth, we have unanimous bullish consensus from all 5 major sources. Fifth, short-term, we see 65% probability of reaching $156 within 1 to 2 weeks. Sixth, medium-term, we see 75% probability of grinding higher to $156 to $159 over 1 to 3 months. Seventh, the primary risk is Japanese intervention, with 40% probability above $155. Our final recommendation: buy dips to $153 to $154 with stops below $149, targeting $156 to $159 over 1 to 3 months. The path of least resistance remains to the upside.